Crude oil has been rolling over the last couple of weeks, but yet the S&P 500 has held up pretty well. Maybe that's because the percentage of S&P 500 that is energy stocks has been cut in half. Welcome to Trading Nation. I'm Brian Sullivan, Erin, Gibbs, and Matt Maley, your Trading Nation team today. Erin, I know you guys focus on earnings. Are earnings, among other things, are earnings as a percentage of the S&P for energy just less and less relevant every year?
Yeah. It used to be a much bigger percentage. We would just see a bigger swing at one point. You know, they were almost twice the weight of what that sector is today. Just to give you an idea, right now, the energy sector is expecting about a 300% gain in earnings growth for 2017. Even if you wipe out that 300%, the S&P 500 earnings expectations only goes down about 60 basis points. So you can just see just how little of an impact that is, even with such a big number. So, you know, for energy to really have an impact on the overall broader market and what kind of earnings growth we're expecting, it just has to be astronomical numbers.
Yeah, and we haven't had that. Matt Maley, though, I guess what I said on Power Lunch today and what we've talked about in the past is, yeah, cheap gas is nice, but we haven't gotten rid of the debt story. Still a lot of debt out there on these oil companies' books. It rattled the market a couple of years ago. Do you think it could rear its ugly head and rattle it again?
It certainly could. I mean, there's no question that some of this debt has been either reconstituted or in some cases just disappeared because of bankruptcies a year and a half ago. But there's still a decent amount out there, and we are now just starting to see the effects in the high yield market. We're seeing the HYG starting to roll over a little bit. It's broken its trend line, its short-term trend line, and its 50-day moving average. So that's a warning sign. And if that becomes a bigger, again, when you're in that $40 mid-40s to mid-50s range is one thing. If you start getting the low 40s and then break into the 30s, the ripple effects could be much more than they've been so far. Again, it's held up better because the exposure on the debt side hasn't been as big, but it's still big, and it still will have an impact. So we always know whenever you have credit markets start to see disruptions, it can cause it ripples into many other different markets.
On the trading desk, how big of a topic is crude oil now?
Oh, it's the biggest one, which may be telling us it's finally going to see a bottom near term. But if it continues to go lower, it's going to cause a lot of problems.
Because Erin, when we look at multiples, everybody says, well, don't worry, the stock market goes up, multiples are up, but earnings are going to go up as well. I understand it's a much smaller percentage, but it still matters.
It does matter, but we're still looking at double-digit earnings growth with or without the energy sector growing. So we're still in healthy shape overall for the broader market.
Okay.
Technology is what you really have to worry about.
All right. Okay. Well, thanks for that. Well, that was in our previous segment, by the way, which is a good tease to tell people to make sure they watch both of those on today. Worried about technology. Erin and Matt, thank you both very much. Folks, just pay attention to the oil story. It's one part of a complex global environment. I'm Brian Sullivan. Thanks for watching. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.